Welcome everyone back to Chart Fanatics, the go-to channel for all the very best trading strategies in the world with the very best traders in the world as well. And talking of which, we have a phenomenal trader with us today. I've been super excited for this very episode. I've actually waited years for this. And it's the one and only, the founder of Investor Trade, the one and only Carmine.
Thanks for having me on here.
My absolute pleasure, man. Like I said, we've discussed this on a podcast we did probably almost 2 years ago now about charts. We were missing the charts. We were missing the strategies. So today's the day. And we're going to do a masterclass into not just order flow, but a specific order flow strategy, right?
Right. Yeah, I think like on our last podcast, we could sit down face to face and talk, but like having a visual like we're going to have here really puts the concepts together and the audience can really visualize it and see it and then kind of put it to the test.
I'm excited, man. Where should we begin?
So what I call this strategy and order flow, how I view order flow is it's the mechanics behind why the market moves. The candles form, the market moves up and down because somebody places an order. We don't know who places an order, but we know there's a buy or a sell order coming into the market. So I firmly believe that reading the order flow is the most important concept in the market because you can follow the footsteps of larger buyers, larger sellers, and then follow their trail. And then it'll provide high probability levels where the market could either reverse or continue. So this strategy has to deal with combining price action, supply demand, key levels, support resistance with the order flow and the volume around these levels of interest. So I guess we could begin with, we could call it a 4 or 5 step process to this. I'm going to call this strategy how I describe it is low volume nodes. So LVN is just low volume node. And this is just like a branch to order flow. And the tool to do this with, you could use any tool that has to deal with volume by price. I find volume by price to be more significant than volume by time. A lot of traders draw like a candlestick chart, right? And then they have the volume down here. The volume increases, the volume decreases, the volume increases. That's fine, but this strategy, I find volume by price being more significant than this is volume by time. And now we have volume by price. So let's just say this is at $100. This is at $50, and this is $0. Let's say at $100, there's a lot of volume, and we can see this by the volume building again by price. Then the market comes down to call it $80, volume's a little less, and then at $50, volume's like really, really high. We can distribute volume by price and then volume by time. I find volume by price to be way more significant than volume by time because volume by price will tell us at what price was there a lot of volume or what price was there minimal volume versus volume by time will just show us volume at that specific time frame chart that we're looking at. And for me, it doesn't give enough information that I can make a quality trading decision off of alone. It's good, it works, but alone, I find volume by price to be a lot more leading in terms of strategy. So
precision behind it.
A lot more precision behind it because, again, the market's an auction. So look at this as a real estate auction, right? Someone's looking to buy a house at $100,000, $50,000. Well, if the market's coming up to $100,000, do we have a lot of buyers, a lot of sellers? Do we have maybe not a lot of buyers and a lot of sellers? And this gives us more important information about the market than by time. I don't care if somebody buys something in March, June, January. I care about what price are people willing to buy at and how much of it.
Got you.
So that's volume by price versus volume by time. Now, there's a couple tools that we can do this with. And again, different tools are going to show us the same information, just in a different way.
Yeah.
So a couple tools right off the bat. Depth of market, which just shows us price and volume. Heat map, which will show us, I have plenty of examples, which we're going to get into in a bit. A footprint chart shows us completed transactions, volume by price. Heat map, footprint, depth of market, and a volume profile. Just a normal volume profile that people could even put on a candlestick chart like I just drew. So low volume node, 4 or 5 steps to this process. The first step, we're going to mark we want to identify a level of support, level of resistance, or a level of demand, or a level of supply. In this example, let's say we had the market beginning to sell off, and then all of a sudden, during the sell-off, the market begins to consolidate for a little time.
Right.
Let's act like these are candles, not just lines. Following this move of consolidation right here, the market then impulsively moves up. This level of consolidation now becomes, for me, a level of interest to watch at some point in the future for the market to possibly come back down and revisit this level. So this is point number one, is establishing a level of supply, a level of demand, or even just a level of support and resistance. We want to first come up with an area of interest or a level of interest that we are watching the market cautiously around. Step number two is then waiting for the market to revisit this level and then have, let's say, a rally up. If we're talking about support or demand, we want to see the rally up. The concept of this strategy is it puts us in the position of large buyers or large sellers defending price, is what I call it. If the market's downtrending, I'm not the biggest fan of trying to catch the market, let's just say, long at a demand zone.
Yeah.
So this enables the market to rally. We will then miss this rally, but the part of this strategy is that this rally right here will make buyers, in this example, buyers, it could be sellers if we're talking about supply, factored into the market. And the concept of this strategy is then a pullback or retest of the buyers for large buyers to defend price. So point number two, let's talk about now, is after the market revisits this level of demand, we want to see strong buying activity or selling activity, if we're talking about supply, out of that level. Now, why that's important, step number two, is because the concept, again, of the strategy is we want to make sure buyers are factored into the market. This is going to dive into the concepts of low volume, because on this rally, when we use a tool like a volume profile, we're going to see the volume distribution on this rally up. And what we're going to look for is areas where the market did not transact a lot of volume at the impulsive move up or down from the level of interest.
Right.
Because that impulsive move up just means that large buyers or sellers are in the market. So then step number four would be waiting for a revisit of this level of low volume, waiting for confirmation here, because now we can follow the footsteps of the large buyers that were in this rally to then follow their footsteps and take long and look for continuation up and profit to the upside. So it's a multiple step process. And why I like this strategy is because we're not really getting in at our level of interest. We're letting the market kind of bounce or sell off from the level of interest, prove that buyers or sellers are there. So we have evidence that the buyers or sellers, and then we look for a revisit of those buyers and sellers. And if they support the market there or resist the market there, we just know that they're really strong and they have an agenda to either bring the market up or down. I think it's going to be good when we get into the visuals. You can kind of see this on the charts, but it's important to use the volume on the move up or the move down of supply to see where areas of low volume come from.
Okay. So we love it because obviously it's definitely giving you that confirmation, but more so than just confirmation, because people who are using just normal candlesticks could say that, right? We're actually understanding what's going on behind those candles, where those orders are, where the auctions are taking place, and where the stronger out of the buyers or sellers are taking place.
Right.
Like you said, the low volume areas. Right. What we're interested in.
Hey guys, just a very, very quick one. If you're enjoying this playbook and you want to get it sent directly to you, make sure to go on chartfanatics.com, put your email in, and every episode we drop, we will send you a direct PDF breaking down this exact playbook. Or alternatively, also, the playbooks will be put all together with the rules over on TradeZella. That is an incredible collaboration. So if you want to actually add the playbook to your TradeZella, make sure you go check that out as well. But let's get back into this episode.
So now we can even flip this to the level of supply. So let's just say we have the market moving up, we have a period of consolidation, and then we have an impulsive move to the downside. This level right here becomes our level of interest. We then wait for the market to revisit this level of interest. Now, I think it's important to understand why the market will revisit levels or why traders stop out. It's to pick up liquidity. The concept of why a level of resistance forms or a level of supply forms is because there were more sellers passively than there were buyers.
Yeah.
So the idea here is that whoever did not get to transact in this area, the market will revisit this area to then, I guess, sellers would look to reload, we could say, to get filled more position if they have an agenda to bring the market down even more. Now, making this concept even more powerful is that once the market revisits this level of interest and sells off, we know, number one, sellers are here at this level of supply or level of resistance. Number two, sellers are here because they just rejected the market again. And then number three, when the market aggressively sells off, it's going to, what we look for is levels of low volume on the sell-off. The levels of low volume indicate that the selling volume was so strong that the market moved down with ease, enabling an area where the market can possibly revisit again for those sellers to reload for more continuation to the downside. So it's just very powerful because we're not getting in on the first sign of buying or selling.
Yeah.
We're getting in once they prove themselves and then a retest where they can look to reload.
Of course.
A concept with the market is that a large buyer or a large seller, for them to actually get filled and facilitate like a large order in the market, is they need to buy when everybody else is selling and they need to sell when everybody else is buying.
Mm-hmm.
So this concept kind of validates that even more, that when traders are stopping out or when traders are looking to get shaken out of a position, it's a very good opportunity for other larger participants to reload in the market. And again, we just follow their footsteps.
Definitely. So like, just to reiterate, when that price comes down and we actually revisit, there's going to be those traders who are loading up longs.
Exactly.
Right. Which is then adding, providing that liquidity as well. And then same with that rebound. If we then come back down and there is an area for us, same thing. Once it rebounds again, more longs.
Exactly. And then even this impulsive move up right here will attract longs. They'll say, hey, the market's bouncing here. Let me get in long. And again, putting context together, this was an area where sellers were present here. So now everybody's buying this move where a seller is, providing a perfect opportunity for the market to reverse. And this right here is where we're looking to trade. Not so much up here for this specific strategy.
100%, because you could trade here, but then obviously the risk is much higher versus the confirmation of getting these moves down.
Yes.
And identifying this.
And that also, this just puts you in a better position because we've proved the strength from the buyers or sellers already. And we're just following their footsteps instead of us trying to be the first seller here or the first buyer if the market's selling off.
Exactly, yeah.
So a couple pros with this strategy is, number one, we're obviously following the footsteps of other larger traders in the market.
Yeah.
The concept of support, resistance, supply, demand is obviously we're looking to find these large buyers, large sellers, and then get in on a revisit of this. With using volume by price, it enables us to get kind of pinpointed entries more than candlesticks. And again, this is why I'm a big advocate and why in my strategy it's so important to use volume by price, is because let's just say we wait for a 5-minute candle to bounce the market off our level of interest.
Yeah.
By the time a 5-minute candle closes, the market may be all the way up here or all the way up here. Versus if we see some activity down here, what's stopping us from getting in long down here before that candle develops? So a really good pro of this strategy is it gets us in with a better risk to reward ratio. And it puts us in the position of following the footsteps of larger buyers and sellers. And a very important concept with this strategy and even any other strategy is keeping risk consistent. And I think this is a very important concept. Is yes, it enables us to have better risk to reward and follow the footsteps of other large participants, but not even this specific strategy is when we keep our risk consistent, it enables us to follow that strategy, have losses, and the wins will overtake the losses completely. So what I mean by that is figure out how much money you are willing to risk before you enter that trade. For some people, it could be $100. And in this example, let's just call it $100. I'm willing to risk, call it $100 per trade if I'm wrong on this setup.
Yeah.
So the market's selling off, we bounce up, we leave a level of low volume, we're waiting for the market to revisit this level of low volume and to bounce up. Let's say we get great confirmation to take the market long as it's bouncing off of this level, call it right here. And our stop loss is under this low right here. Depending on the instrument, whatever you trade, let's just say our stop loss down here is about $50 if we trade just one contract or one lot. If we keep our risk around $100 per trade and it's consistent, what this will enable us to do is trade 2 contracts because 50 times 2 is $100. Now, let's say we get a really late entry and our entry is all the way up here. Again, our stop loss down here now is maybe $100. We do that.
We're losing our black pen, eh?
No. Now, if we're entering up here, we can only trade this with one contract because our stop is all the way down here at $100. But now let's just say we get a really, really good entry point and our entry is right here, very, very close to our stop loss. Let's say our stop loss is now only $20 away. We can theoretically trade this with 5 contracts if our entry is here. See how we're adjusting our size relative to the risk?
Yeah.
I think a biggest misconception, and it's so important with the strategy, is keeping the risk consistent and adjusting the size relative to the risk. Every trade is going to have a different stop loss. And I'm going to talk about where I place my stops, where I place my targets. and where I get my entries from. But I think it's so important that no matter where your entry is and relative to your stop loss, adjusting the size relative to that risk. Because if we enter the trade with the same position size on every single trade, some trades we're going to lose $100, $300, $500, and we're going to be digging ourselves in the hole even more. So when you keep your risk consistent and you adjust your size, every loss will be consistent in the same dollar amount.
Yeah.
And what this enables us to do is now let's just draw a P&L curve. Let's act like this is our P&L curve over a month period. What this is going to do is if we focus on risk to reward ratios, with this strategy, I get risk to rewards, and you're going to see it in my trades, 5-to-1, 6-to-1. I get very high risk to rewards because, again, I'm placing myself in the position of large buyers and large sellers. Let's say we get 5-to-1 risk to reward ratios and our average loss is around $100. That means our average win is around $500. One win will put us up, call it $500 right here. We take one loss with consistent risk, $100. We take another loss in a row, another 100, another loss in a row. We just took 3 losses in a row and we're still up $200 on our P&L curve.
Yeah.
Versus if you don't keep your risk consistent, you win $500 on one trade. You take a losing trade, you lose $300. Now you're down. Next trade, you lose $1,000. Now you're way down in your negative P&L curve. And if you don't have good reward when you're right, it's going to take you a while to build this P&L curve up. Yeah. So it's so important with this strategy, with any strategy, to keeping the risk consistent and adjusting your lot size, your position size, whatever you want to call it, relative to the risk. And everybody's dollar amount is going to be different. Mine right now is between $3,500 and $4,500 per trade. And if I look at all my losses, it's between that amount because I'm not having larger losses. It just puts me deeper in a hole.
Yeah.
And I think that's an important concept. And that's a pro of the strategy with better risk to reward, as long as you keep your risk very, very consistent.
Of course.
Let's take a break for a minute there, guys, because I want to tell you about our preferred prop firm, Apex Trader Funding. Now, Apex is no stranger to the podcast or even Chart Fanatics because we've done 2 incredible episodes with 2 record holders in terms of Trader Kane, who got a record payout at $2.3 million at Apex. And then beating that record in the end was JadeCap, aka Kyle, who also then has a record payout now of over $2.5 million in a single payout with Apex. And that really just shows the infinite possibilities you can achieve at Apex Trader Funding. Now, what traders love about Apex is that you can get up to 20 accounts. So whether you get the 25K account ranging all the way up to the 300K account, you can get 20 of those. So if it's 20 300K accounts, that is 6 million in tradable capital, which is absolutely incredible. Not only that, it's only a 1-phase evaluation, there's no daily drawdown, and up to $25,000 per account is 100% yours. And after that, it's a 90% split in your favor. That's right. At Apex, you can actually trade with Wealth Charts, Tradeovate, and Ninja Trader, so you can choose your favorite trading platform. And not only that, you will actually get real-time data included when purchasing your evaluation with Apex. What I personally love about Apex is that as long as you're trading your day-to-day strategy, you don't have to worry about trading the news. You can actually request your payouts every 8 days, and there's actually no cap to your max payout, which really shows the infinite possibilities you can have at Apex. Thanks to Chart Fanatics, you can get the best offer available at Apex. They are always running sales. So make sure to use the code CF that will automatically give you the best offer available at Apex. The link for Apex Trader Funding is in the description below. So click that link, use the code CF, and you will get the best offer available. Become an Apex trader today. Now let's get back to the episode.
And would you say that the strategy itself, is it fractal in terms of, like, I know we were talking probably a bit lower time frame. Can you also apply it at higher time frame?
Yeah, so I'm going to show you an example of a higher time frame chart, but a lot of this is lower time frame.
Gotcha.
And I guess you could say scalping.
Yeah.
I find the best opportunities come in the first 2-3 hours of the market being open. I like hitting my setup with these trades and walking away and going to enjoy the rest of my day behind the screen, out of the screens. But I find the volatility is important. And when there's volatility, this works very, very well because volume, again, moves the market. So you want to make sure that volatility is in the market. But yeah, in the first 2-3 hours, I find it to be the best. You can apply this for longer term trading for sure. I just find that some of these moves happen in 5, 10, 15 minutes, and that's it. They happen quick because, again, we're looking to capitalize on the quick short-term movements in the market. And let's talk about cons now. So the cons, and you're going to see this in the examples that I show you.
Yeah.
The cons is that sometimes, let's say the market rallies and we have a really strong bullish move. Sometimes there will be a lot of levels of low volume, one right here, maybe one right here. And it'll be hard to kind of distinguish between, should I watch the pullback into here? Should I watch the pullback into this one? Should I watch the pullback into this last one down here? So sometimes it's a little difficult to distinguish this. And this is why it's so important to understand the first 4 or 5 points that I mentioned in the beginning of this video.
Yeah.
Is because it's important to gauge where the location of this formed. And it'll be more effective if the market bounces or rejects at a level of interest. So again, we wait for the market to bounce off a level of demand, pulls back, bounces. On this bounce, it's going to leave a level of low volume, where then we look to play the pullback, catch the market long. It's more valuable to play an area of low volume after the initiation move of the level of interest versus after the market maybe made an extended move. And I'm going to show you all a losing trade that I took. And the losing trade that I took happened to do with initiating a trade at the highs of an area of low volume versus initiating it at the lows of where that move initiated from.
Yeah.
So that's definitely a con to the strategy.
Multiple areas.
There's multiple areas, and I'm going to show you a losing trade, and that's going to visualize it a lot better. And I would say that's really the only con. A pro and a con of this as well, I guess we could combine this into one, is let's say we have the rally, we have our level of low volume right here, we're waiting for the pullback into it, market pulls back. Sometimes the market just blows right past it and doesn't react to it at all. And there are some confirmations, which again is a pro and con, that I will get in long, or I'll play a bullish position here, just because there's an impulsive, aggressive, violent move down that happens so quickly that I act upon it.
Yeah.
A portion of the strategy, again, is how I view the market is trading where there is pain in the market, because where there is pain, there is gain.
Yeah.
It's not, really good to say that, but it's true. Where there's an edge is where there's pain in the market. So when the market's aggressively and impulsively selling off, you're going to have a lot of traders freaking out, selling their position, stopping out. And the quicker this happens, the more impulsive, the more aggressive, the more violent this is, the more times that I'll just simply long the market because it sold off a lot of points in a 5-second period because of that impulsive move. Because that impulsive move is an active trader stopping out, and these buyers that we're spotting here to, again, defend price where we look to capitalize on that upside move. So it's a pro and con because sometimes it just impulsively moves down and keeps selling off.
Yeah.
And sometimes it's a pro because we get the impulsive move up, happens so fast that a lot of traders can't act upon it. Or when they act upon it, they're acting upon their emotions. And this is where there's a great edge from that right there. And it's a pro and con because it's sometimes the trade stops you out in 10 seconds, 20 seconds.
Yeah.
Or sometimes you get a great entry and your risk is like 1 point away and you could trade with such large size because your risk is so small and your reward is so high. That's when we're talking like 10-to-1 risk to reward ratios.
Incredible. And then the only other con I would mention in terms of like if we're scalping, as you said, the specific time window. And again, just to, as I always mention in every episode, cons aren't necessarily meaning it bad. It's more so just what to be aware of. If you're going to look to implement this or look at this deeper, these are the things to be aware of. That could be hurdles or challenges or just pain points, if you will. And one just being that time window. Then if we're focused on a specific time window, those with jobs, for example, or particular routines might be a little bit difficult to execute exactly how we're showing right here.
And another, I guess you could say con is that you have to be very focused. I feel like a lack of traders have focus and patience, and you really have to just be dialed into the charts and dialed into like the shape of the profile and dial into the candles, because you could easily miss this. It happens. And if you're not focused and watching this, it could happen so quickly and you just missed a great opportunity,
Definitely.
So you have to be focused. In this strategy, in any strategy, you have to be so focused and lasered in.
I'll say another pro, though, is actually this is the real way of seeing the order book and order flow. Because a lot of, you've probably seen it, a lot of concepts out there will make out, this is order flow, this is volume, etc. But it's not really the true essence.
Right.
Well, this is actually the real auction, the real orders. So that's definitely a pro.
Right, definitely a pro. And what I find is BS in this industry is that a lot of traders call this a fair value gap. Like a lot of,
I was going to mention it earlier, but I didn't know if that would be offensive to you.
So in the ICT world, I just found this out because I've been posting about these trades and everybody's like, you're just trading a fair value gap. This is why fair value gaps form.
Yeah.
And it's still a little different. The concepts of this is relating to an auction versus the concepts of a fair value gap is just a pattern of a candlestick chart.
Yeah.
So really, this is just the underlying driving forces of a fair value gap. Again, fair value gaps don't have to deal with supply or demand zones, but why I look for supply demand zone support resistance is because we want to find the buyers and sellers there. So again, just to reiterate this point, the market sells off. We have this level of demand. We can mark this as a demand zone. 2 days later, maybe 30 minutes later, maybe even 3 weeks later, the market rallies and then revisits this level of demand. We revisit it, it bounces. On this bounce up, what traders will see is a really strong rally candle to the upside, and then they'll mark their fair value gap somewhere in this area.
Mm-hmm.
They'll see a candle, right? And then they'll mark, maybe there's no wick. They'll mark the bottom of this candle and say, this is a fair value gap right here.
Yeah.
But the concepts of it is on that green candle to the upside, the market moved so strongly, so violently, so aggressively and impulsively that there was so much buying activity that the market either skipped, jumped, or because it was so aggressive, not every single buyer was able to get filled on that move. So the concept is waiting for a retest of this to then play the market long and capitalize on that move. So it is similar to a fair value gap. I find you saying it's a fair value gap is wrong because this has to deal with order flow and the driving mechanics of the market, which is...
This is telling you why it's a fair value gap, essentially, right? Versus here's just, as you say, a chart pattern to look for or utilize. This is giving you the actual reasoning, the why, which is actually more powerful because once you understand that, your confidence in it, your understanding of it, and then your application and execution of it is so much stronger.
Right. And I feel like a lot of the concepts, fair value gap, whatever these traders may use, I find that the driving mechanics behind the candles is the order flow. Yeah. So if you can read that order flow, it's just going to give you the truest, clearest picture.
Definitely.
And I feel like it'll give you more confidence, like you said, and it'll help you, like, no matter what gets done, an order has to be placed. You see a green candle, you see a red candle, an order has to be placed. So being able to read the orders kind of gets you in, I don't want to say before the candles, but it tells you why the candles are actually moving and why they're driven.
Exactly.
And it gives you just, I find, more reliability and more confidence. Versus you have other traders that don't even use order flow, but they see the patterns and that pattern gives them the edge themselves. And that's totally fine. It's just that this gives me confidence and reliability that I can't get off of a candlestick.
Exactly.
And off of a candlestick alone, this strategy won't be as effective is because you need to see the volume.
100%. Yeah. 100%. Is it time to pull out the charts?
For sure. Now let's get into visualize all these charts now. So, all right. So I'm going to show you 4 different trades. 2 of them are going to be one's going to be a long, one's going to be a short. The next trade is going to be a losing trade because I want to highlight what the setup looks like and how it looks so good and some mistakes behind it. And then I'll show you like a bonus setup that kind of makes you think outside the box a little bit.
Cool.
So the first trade is going to be a $15,000 profit. It's a 4.5 to 1 realized risk to reward ratio. And again, like that's the biggest concept is that I feel like with this strategy, it just enables me to have higher risk to reward ratios. And that kind of takes the pressure off my back a little bit because I don't need to have a high win rate. My win rate could be some months 30%, 40%. It could be a lower win rate, but I know I can have the backbone of my risk to reward outweighing this. When my losses are 3,000, 4,000, and my wins are 15,000, 20,000, I know I could afford 3 losing trades in a row. 1 winning trade will just make me green.
Exactly.
So this is a 4.5 to 1 risk to reward ratio. It's a $15,000 profit. I was risking $3,300. And in this chart right here, we could just see a simple rejection that I've highlighted by this pink box labeled sellers, where my entry was short. And then I took profits. I didn't even get a large portion of this move, which is pretty crazy to even think about. It was just a simple quick scalp off of large sellers defending price. And up top here, we could see a supply zone where the market rejected. And we're going to label this setup as short, low volume node into 5360. And that's another thing I want to talk about. I think it's so important to label the setups that you take. If I could take a setup and I could say, hey, this was a low volume node. Hey, this was a bounce off demand. This was a rejection of a level of supply. If you can label it, it'll keep you on your toes to make sure you're taking a setup that you know is out of your playbook. And that's the point of this setup. The strategy is this is just low volume nodes and this is one strategy to my whole playbook. There's so much more, but this is just the most effective that I've been using. The past 3 months, I've made over 300,000 just using this strategy right here.
Incredible.
So this was something I'm watching was a 5360 was a rally into this. And if sellers appear, another word for offers is sellers, I'm interested in a short targeting the low of day. Here's our level of supply. Here's the period where the market consolidated, followed by an impulsive move to the downside. supply and demand is you want to find the period of consolidation
Mhm.
prior to an impulsive move up or prior to an impulsive move down if you're talking about supply.
Do you know what time frame this is?
This was, I believe, a 30-minute or a 15-minute time frame. And you
Gotcha.
can find supply demand zones, key levels off any time frame.
Mhm.
30-minute.
It's that same
I use,
consolidation.
15-minute, 30-minute, 1 hour, 2 hour, 3 hour, 4 hour daily, weekly. This, I believe, is a 15-minute or 30-minute, but the concepts are still the same. The data behind each time frame is going to be the same. It's just showing you a little bit of a different picture.
Of course.
So here's a revisit of the level of supply, and then the market pulls back and rejects that supply. Again, we're not looking to take with this specific strategy. We may have missed the sell-off from supply. We may have not seen confirmation there. This sell-off from supply is just validating that sellers are there rejecting the level of supply.
Yeah.
Let's take a break for a minute there, guys, because I want to tell you about our incredible sponsor, TradeZeller. TradeZeller is the #1 trading tool in the entire trading industry. TradeZeller allows you to become a more profitable trader, allows you to make immense progress as a trader, no matter if you're a beginner or an advanced level trader, because it makes journaling easy. It makes journaling something that is fun and enjoyable and something that is interactive. So no matter if you're a crypto trader, no matter if you're a futures trader, no matter if you're a Forex trader, no matter if you're a stock trader, all you have to do is select your broker, your platform of choice, and connect it to TradeZeller, and it will automatically sync your trades and pull all of that data onto the dashboard, making journaling and finding your edge and adapting your edge so easy. In collaboration with TradeZeller and Chart Fanatics specifically, we are actually getting the playbooks from the episodes that we're filming with these incredible verified traders and adding them as playbooks onto TradeZeller, so you can actually go on there and see the rule sets already predefined. So make sure you check that out as well. Now you can actually get 10% off your monthly subscription using CF10 on TradeZeller right now. But more importantly, I would say CF20 for 20% off your yearly subscription with TradeZeller. The links for TradeZeller are in the description below, so make sure you go check them out. Use CF20, get 20% off your yearly subscription, become a better trader today. Now let's get back to the episode.
Here's another rejection in the overnight session. The market rejects. We open up. And when we open up, we're now in a downtrend, putting in lower lows and lower highs from where these green lines are right here.
Yeah.
Lower lows, lower highs in a downtrend when the market opens up. Now here is a very good example of a volume profile to the right compared to the chart on the left. Again, a volume profile just shows us volume by price, not volume by time. So we can see all the prices highlighted here, 53.85 all the way down to 53.15, which is just the exact range of this chart right here.
Yeah.
This is a volume distribution or a volume histogram of volume at specific prices from this chart at this exact moment right here. So between 53.75, 53.70, if I just turn on the pen right here, from 53.75 to 53.70, there's an area of higher volume in this range. We also have some higher volume here around 53.56.
You identify it by, of course, the increased
volume
right, yeah.
distribution. So this is a volume distribution. When the bulges are higher,
Yep.
the volume's higher.
Yep.
When the bulges are lower, the volume's lower. And why this is significant is because where I just highlighted these two areas of higher volume,
Yep.
in between this is an area of lower volume compared to the rest of the profile previously in the day so far.
Right.
We could say there's an area of low volume here, but it's not as significant because this is in between the bulge of two higher volume areas. Another reason why this is significant, again, this is kind of where context is important, is because prior to this, the market had rejected the level of supply and sold off. We know it's safe to say sellers are factored in at this area. When the market sells off then, now intraday, this is the 9:30 US Open to about 10:20 US Open. This is about 50 minutes in time. We can see the market selling off right here. Now, what caused the market to sell off? We don't know. But we know there's aggressive selling here because of this area of low volume right here. And this is why I was then watching for a rally into 53.60 area of low volume, because this would be an area where the sellers were very aggressive. The market sold off. And why these areas form is because the market aggressively moves down or up. And because of how aggressive and violent it is, it didn't spend much time there or didn't really transact much volume.
Yes.
That's why these areas of low volume form, is because not much time and not much volume was spent there. If there was more time, maybe we were consolidating here for like 20, 30 minutes, you wouldn't see this area of low volume. But because the market basically moved through these 53.60s, 53.65s with ease, and didn't spend much time, this becomes our level of low volume to watch the market rally into. And if it rejects, we get confirmation. I'm going to show you that. We look to play the market short and play a reversal here. Now, it's so important, again, to use confirmation at these levels of interest. We can't, I said the pro and the con before was simply waiting for an impulsive move up. That impulsive move up is confirmation in itself. But just entering because we're at a level of interest is not viable, because you want to put yourself again in the position of those buyers and sellers. So in this example, we could see after this level forms, about 10 minutes after, we rally into this and we do reject. And this was a setup that I did not take despite the rejection being kind of perfect. Now what I pulled up here is a heat map. In very simple terms, we could see a volume distribution here to the right by those specific prices. You could see the area of low volume right here.
Yes.
A heat map just shows us a volume distribution of passive orders and aggressive orders. So any line that we see on the chart, you could see, orange, yellow, and red. The darker the color, the more wall will serve as resistance there, because there are more sellers passively sitting there.
Gotcha.
So almost act like you're in a room and you're trying to go above the ceiling, but the ceiling's made out of cement, and act like cement is tons of sellers there. It's going to be hard to go through that ceiling.
Yeah.
This right here, the darker the line, is just basically the stronger the roof is for the market to move down, or for the market to move up through that.
Just for example, these you got the red line, and then you got some that are a bit darker, a bit orange above that. Are those limit orders? Are those?
So every line here is a limit order, and these are the passive orders. So these are just showing where there's more limit orders at those prices. And again, limit orders are going to be like walls, or they're going to be like resistance or support.
Yeah.
So if the market's coming up to this and we cannot break above it, it's going to be a ceiling to price, and that's where you're going to get that resistance or that rejection.
Got you.
On top of the lines being just limit orders, the bubbles show completed transactions. So green bubbles just indicate large buying volume, and red bubbles just indicate large selling volume. So if the market's rallying, let's just say into a level of resistance where we could see a lot of passive sell orders sitting up here, like there's a lot of sellers acting like a ceiling to price. If the buyers really try to bring the market higher, you can see by this really large green bubble here, and they fail to do so, that is a very bearish indication, because what that says is that there wasn't enough buyers to bring the market above that wall of sellers.
Yeah.
And if that's the case, the market's only going to have an option to move down. And this is how an auction actually facilitates trade.
And that's in line with your lower volume to the...
And exactly. So I lined that up, or I didn't line it up, the market did it right at 53.60. And that's right at our level of interest. Now, the reason why I'm highlighting this is because this is a setup that I did not get an entry on, and a setup that I did not take. Now, fast forward this, 10 minutes later, the market breaks this high.
Interesting.
And point number two, if I were, obviously you know what happens because this is a winning trade, but off this chart alone with no context, would you see anything here that would indicate like the market to reverse or sell off? This kind of looks bullish, right? It's making higher highs, higher lows. Nothing really indicates that the market's going to sell off from here. It would be fair to say that, right?
Exactly, yeah.
But point number one is the setup that I missed. Point number two is the setup that I took. And this is where I found good enough confirmation to take this short. I got short at the 51.60s. My stop loss was the 65s or the 80s, and I was targeting the low of day. I'll get into my targets when I show you what this trade does, but I was targeting the low of day. So I got short at the 51.60s, and I put my stop above the 80s.
Yeah.
And my target was the low of day. I'll get into my targets in a few when I explain the outcome of this trade. But I basically had very small risk and very high reward, and these were the confirmations. Rejection of the supply zone in the pre-market session, the low volume node that formed at the 60s that I just showed, and then the market rallies into this level of low volume, and we saw the passive sellers that I just showed you.
Yeah.
Where now I'm going to show you an example of aggressive sellers, and this was my confirmation to take the market short. And then we're going to see a large negative delta, which just indicates that the sellers were more aggressive there than the buyers were, which I'm going to show you. So here's the more passive sellers there. That was the first confirmation. The second confirmation was, again, shorting into the strength. This was my entry here. I believe I got short at the 65s. And here are my exits down here, and another one down here. Here's point number 1 and 2. So here's the original passive seller at the high, serving like a wall. Point number 2 now, this is what made me click the sell trigger to actually enter this trade, was that here at the high, you could see a large red bubble.
Yes.
Which just indicates as the market was rallying up, there was a large aggressive seller in the market. So different from the first one, there was a large passive seller. Now there's a large aggressive seller as the market's moving up at this 53.60, 53.75 level of low volume. And this aggressive selling, we can see it highlighted down here by time, but more importantly, volume by price, gave me the confirmation to take this market short along with everything that I've been mentioning so far. And now this is a footprint chart. I'm not going to dive much into footprint charts. On my channel, I have like a full order flow series.
Gotcha.
And on that series, I explain all the ins and outs of all these things if anybody's ever confused about it. But this just shows, again, volume by price in a different format.
Right.
If there's more selling at a level, it's going to be red. And if there's more buying at a level aggressively, it's going to be blue.
Right.
In this example, we could see a delta outlier is what I call it, which just means there's an outlier in the volume that is different than the volume that is normal in the current market. What I mean by that is at this price here, 53.68, there's a negative delta of minus 482. If we were to look at the delta or the volume previously, we see nothing even above 100. So something to come in and aggressively sell over 400 contracts is an outlier in the data.
Right. Yeah.
It is the difference between the buyers and sellers. Ask data minus bid data.
Gotcha.
So you have more buyers than sellers, it'll be positive. If you have more sellers than buyers, it'll be negative. So this just shows as the market was rallying here, this large red bubble, that indicates that there was more aggressive sellers at this price than there were buyers. And this gave me my confirmation to short the market as the selling activity came to the market. And then I took profits into the low a day. So a lot of my targets are low a day, high a day, levels of support, levels of resistance, anywhere the market can potentially reverse. The way I put myself is in the position of other traders. If there actually are sellers here and I'm reading this correctly, if I was a seller here, where would I look to maybe reduce my trade, maybe take off some contracts? Where could the market potentially reverse on me? My targets are always placed where the market can potentially reverse. I don't want to put myself in a position that I'm not selling into a level where the market could move against me. So low a days, high a day, resistance, supply, anywhere the market can reverse. And I try to put myself in the position of other traders because that'll give me an edge of knowing where, if sellers are here, all right, let me take some off at the low a day. And I took some off under this low and then not more into the low a day, and I scaled out of the position.
How important is it in terms of speed of execution?
So that's a very good question because in the market, there's a concept called the speed of the tape. And if you're reading volume, even if you're reading candles, let's say candles are printing very fast, that usually means there's a lot of volatility in the market. And if there's a lot of volatility, there's a lot of volume in the market. So how fast the market moves is important because you want to see a very fast moving candle if you use candles. In my instance, it's using the volume because when there's a fast moving market and the pace of the tape, the speed of the tape is fast, there's a lot of volume coming into the market, and that's where you want to act. When it's moving slow, there's not much volume. Nobody really cares about it. When it's moving fast, there's a lot of participants actively there, and we look to act upon these participants. So yes, pace of the tape, speed of the tape is very important. And going back to the question that you asked me earlier about, can this be done on higher time frame? This is a volume profile similar to what I drew earlier on the whiteboard of the volume for that specific day. So this volume distribution right here is just for this specific day, and it gets cut off right there. The next volume distribution is just for this day right here. On the day to the right, which I'm going to highlight, or the left, which I'm going to highlight by 1 right here, we could see this area of low volume in this range right here. You see that pretty clear. If we were to make this a level of interest, the day that I took the market short here, we pulled back perfectly into this area of low volume that formed from the day prior and actually bounced. And this is kind of where you could get your higher time frame for people that are like more swing traders or longer time frame day traders can look to do this. You don't have to do it short term. This is a perfect example of looking for a volume distribution from the day prior and a perfect pullback. And this is a 30-minute chart, and the market rallies the S&P 200 plus points from this, and that's a significant move.
Let's take a break for a minute there, guys, because I want to tell you about our incredible partnership with PropFirmTrader.com. Majority of you out there are prop firm traders. You're using prop firms to leverage your trading skills to be able to get more capital and to be able to absolutely change your life. So what's important to you? To be able to find the right challenge for you with the best firms and, most of all, the best prices. And that is exactly what PropFirmTrader.com does. PropFirmTrader.com allows you to compare prop firms, be able to find the best challenge suited to your trading style, and get you the exclusive best discounts in the entire industry so that you're paying the cheapest price possible for your prop firm challenge. So on propfirmtrader.com, you'll be able to use filters to be able to do that and find the exact challenge for you, be able to find your favorite prop firms. On the futures side, we have the biggest futures firm in the entire industry with Apex Trader Funding, giving us the best discount possible. Right now, it's actually 80% off using the code PFT. On the CFD side, on Forex side, we actually have a broker-backed prop firm called Atmos Funded, backed by Torex, and they are giving an exclusive offer at 50% off all challenges. Again, using the code PFT. So make sure you go do that. And not only that, another exclusive offer only on Prop Firm Trader is with Bright Funded. Bright Funded are giving up to 30% off all challenges and a free account of the same size on your first payout. And on top of that, you can get an exclusive offer only on propfirmtrader.com with Alpha Capital on their one-step challenge, 25% off using PFT1. So make sure you go and do that. And there's so many more exclusive discounts only on propfirmtrader.com. It is the go-to site for all prop firm traders out there. And one thing I'm really excited about that I personally helped to organize was the giveaway of giveaways, the 7-figure giveaway, just through purchasing your challenges for the best price through propfirmtrader.com. Every single week, you will automatically be entered into an incredible giveaway, a collaborative effort across all of these firms on screen, between 100 to 200K accounts, over 7 figures. It means that one person every single week who's made a purchase through propfirmtrader.com will be getting 7 figures in challenges that could completely revolutionize your trading journey. Again, all you do is for any of the firms on propfirmtrader.com, use the code PFT at checkout, and you will automatically be entered every single week. The link for propfirmtrader.com is in the description below. Now let's get back to the episode.
You can see the fair value gap in chart pattern terms.
Right here, right?
Area.
Exact area. Yeah, right here, right?
Mm-hmm.
Yeah, so this is a perfect visual of comparing a fair value gap. I'm sure they would draw it maybe from here.
Yeah, they would.
But that, again, is kind of narrowing it down and kind of getting it more reliable information of confirming it with the volume and the order flow.
Well, look at the clear difference between, I would just draw a rectangle there,
Right.
and then say, okay, price comes in here, what? But versus actually understanding why that's there, understanding what's behind it, understanding how to react. And actually, in this particular case, as you said, it's actually more refined by having that understanding too.
Yeah, so I think it's a very good example of fair value gap, longer time frame chart. And this could have been a good target too. Like that short trade that I took up here at the 5360s. This was my entry up here, 5360.
Back to your point there, as you mentioned, in terms of picking your take profits, price could have at the low of debt reversed. And therefore, if you had held that trade, all that work, that deciphering of the charts and everything, and that patience to then execute is wasted.
Exactly. And that's why it's so important to follow the plan. And look, could have been a good target. And we could say all we want, coulda, shoulda, woulda, but it's how you execute the trade. If you look at my entries and my exits here, my exits were nowhere near the low of that move. And this would have been a very life-changing move if I could have called it that low, but you can't look at that. I got to look at, I had a plan. I followed my plan. I sold when I had to sell. I took profit when I had to take profit. And that's the only thing I have control of, is just following my plan and managing my risk. I can't look at where the market went next. It could have easily reversed on me, and this could have been a losing trade.
Exactly. Do you have scenarios though where you do hold to a longer target at all?
It depends on the market's conditions and the market context. Not every trade. For me, I like hitting my target, getting out, and then looking for another entry somewhere else. I'm looking to capitalize on the short-term price movements in the market. I'm going for quickly who's in pain, because that's where I want to gain from. Longer time frame trends, if there's a lot of volatility, if the ranges are higher, then I'll scale out and maybe hold for a larger move. But for me, I like being in and out because these moves happen multiple times a day. And being able to capitalize on it, trading for 20, 30 minutes and walking away and going to enjoy the rest of the day, that's where I like doing it instead of being glued to my screen for 4 hours.
Well, that looks like if this
about 3.5 hours, 4 hours
type of $1,000 for this trade as well.
And
the amount of time is incredible. And to your point there, this is what I was asking as well. Like, I feel like sometimes traders try to be this hybrid trader all the time of like, I'm a scalper, I'm a day trader and a swing trader all at once. And it's so hard to focus and be able to manage all those different roles. A lot of the time, no one really pulls it off. Whereas, as you said, what type of trading you're doing, the style of trading you're doing, what your execution is meant for and your take profits meant for, and then sticking to that. That's where the consistency starts to come in. And as you say, though, knowing context is the biggest word I think that you said, really, in terms of when you decide to hold longer. It's the context, it's the market telling you, and the ranges as well, being larger for you as well, that then allows that to happen. Plus, as you mentioned, in terms of in the very beginning, the way you do your sizing, right, allow you to take the exact same trades, but have actually a higher reward just based on the way that you do the sizing. Which is incredible.
Yeah, I mean, if I held this trade, this would have been, if my target was even lower, this could have been a 30 to 1, 50 to 1 risk to reward ratio. But that's like insane. You know, no trader's going for a 30 to 50 to 1 risk to reward ratio. I'm going for quick moves and that's it. So to your point, I have a rule called the CLC rule. Context, location, confirmation. And this kind of validates it. What's the context of the market?
Yep.
Where's the location of the market? And what's the confirmation of the setup? And these trades, this trade and all the next trades that I'm going to show you kind of validates that CLC rule. And it's so important because the setups that I take are so repeatable. The patterns appear and I know this is a trade that I should be taking. So going into your point of knowing the type of trader you are before you take that setup is like, I'm going for scalps most of the time.
Yeah.
What a lot of people do is they'll enter like a longer time frame trade and they'll turn it into a scalp because they didn't manage that trade properly.
Yes.
But you have to know the type of trader you are and you have to know the type of trade that you're entering before you enter it. That way there's no surprises, there's no mistakes, there's no uncertainties that is out of your control.
Okay.
You know, so it's so important to know the type of trader you are and the setups that you're looking to take. So now this was a long trade that I took, long position, bullish, $21,750 profit. This was a 5.5 to 1 risk to reward ratio.
Wow.
And this trade was 20 minutes in duration. So again, high risk to reward, $4,000 worth of risk. So if my stop loss hit, I would have lost $4,000 to gain, call it $22,000 about. And this was just simply a pullback. We could see the level of demand here. We can see the rally up. We could see an area of low volume, which is marked by that green line.
Yeah.
The market pulls back into this. I get an entry long here and I capitalize on that upside rally and I call it a day. Again, what I was explaining on the whiteboard, it's their strategies to catch the levels when it comes into a key level of demand and support. The concept of this strategy is we want to say that buyers or sellers are strong. In this example, buyers are strong here. They form the level of low volume. We wait for the pullback. The buyers defend the price and we capitalize on that. 5.5 to 1 risk to reward.
All right.
There's a 1 minute chart.
It's like a 10-minute trade.
10-minute trade, not even.
It's incredible.
And this was the level of demand. Here's the period of consolidation. The market 3 weeks later revisits this level.
Okay.
We could see the market in this screenshot. We could kind of see a lower wick right here.
Yeah, just to the right.
Yeah, zooming in a little bit. And the market tries to bounce. Now, the setup is just long and a low volume at the 55.63s. Again, two areas that I'm watching, 55.63 and 55.50. I'm going to show you all the volume distribution of that because here the market was kind of impulsively and aggressively pulling back into that. I got long at the 61s, 4-point stop loss for about a 20-point reward. Again, 5 to 1 risk to reward ratio. And my target was the high a day breakout where I'll exit that position.
Yeah.
Going for a low a day, high a day targets and pretty much a lot of my trades, depending on the location of it. Here's that demand zone, intraday sell-off into the level of demand, and the market bounces. Now, on this bounce, 55.63, where I've highlighted by this green line, is this general range. It doesn't have to be exact. You could say 55.65, 55.57. It's just a general range of an area of low volume right here. Directly under that, we have the 55.50s. So this was a trade that I was watching two different levels to gauge how the market reacts if it pulls back. So here on the chart, 55.63 is the first one. And then even down here, the 55.50s, which I didn't even have marked on this example, but two levels that we're looking for the market to pull back into. Yeah. It's always, what is the reaction at my level of interest? I don't know if my level of interest is going to work, but I want to gauge the reaction and gauge what the market does at that level of interest. So after the demand zone bounce, I marked 55.63 as that level. It pulls back into this level, and we see about 12 minutes of consolidation right here, where the market's kind of in limbo mode. The candles are smaller. There's a lot of wicks. They're very small-bodied candles. Small-bodied candles means the pace of the tape, the speed of the tape was slow. The candles took a little while to develop. It didn't really move in direction or move in price. And these are good opportunities, again, for larger buyers or sellers to accumulate or get in a larger position. They need to buy when everybody else is selling, and they need to sell when everybody else is buying. So these candles that I've highlighted here are significantly smaller compared to the first hour and a half when the market was open. Significantly different. On top of this, the context of it was demand zone. It rallied, formed a low volume node, and now we're consolidating in this range. I want to show you all what price action looks like here.
During that, yeah.
This right here is what the price action looked like right there. And the good thing about a heat map, again, if anybody's ever confused, just go to the order flow series on my channel.
Yeah.
Is this looks identical to this. If you really zoom in and compare, this circled area is the same area right here. The order flow just shows us what's going on behind the candles.
Exactly.
I want to know why we're stalling out here and why we're consolidating. This could also form a level of demand. The market sold off. We consolidate here. Now, if we get the impulsive move up, this could also be a level of demand that's forming here.
Yeah.
To validate that it is a level of demand is there is what I call absorption or a large buyer accumulating. Out of all these things that I've highlighted here, these arrows, as the market's moving down, we see a lot of red bubbles. Again, for traders to buy, they need somebody else to sell to them.
100%.
So if the market's pulling back and there's a lot of selling volume and holding on that period of the pullback or the consolidation with selling volume, it is very safe to say that someone is accumulating a very large, not even a large, but just a long position with an agenda to bring the market up.
When you say someone, do you mean that it could be a group of people?
It could be a group of people. It could be, yes. Yeah, there's traders or a trader looking to accumulate a larger position.
Exactly.
They can't buy when everybody else is buying. They have to buy when everybody else is selling.
Yeah.
For every transaction, there's a buyer and seller. If they're looking to buy, they need somebody to sell to them.
100%.
It's needed in the market. So here, the market was selling, and there's a lot of selling activity. On top of this, you could see a lot of red and orange lines, which just means there's passive buyers in the market. And then zooming really in depth to this right here is just zooming more in depth to what's highlighted here. Every time the market came to the low, we see aggressive selling. Every single arrow that I have highlighted here, there's a large red bubble as the market breaks the previous low. So you have a low here, it breaks. A low here, it breaks. Another low breaks, another low breaks, right? So the pattern continues.
Yeah.
They need traders to sell for them to buy, or whoever it is to buy.
As part of this, it's aggressive selling, but we're not moving lower.
Exactly. So a very bullish thing in the market is if the market's uptrending or moving up, on the pullback, if there's a lot of aggressive selling, somebody has to be buying that selling.
Yeah.
And when you add the CLC rule, the context, location, confirmation, this just validates that all
100%.
Right at the 55.63 key level. Again, if this was in the middle of the range or somewhere just random, it wouldn't be as significant. But this is right at that level of low volume. So when you put all the pieces together, you basically get a very vivid and clear story the market's telling you.
Yeah.
And how I view it is that like the market's a storyteller. When we can read the story it's telling us with more clues and more context, it's going to be easier to know what happens next, you could say, or has a higher probability of occurring next. And that's where we look to take advantage of.
The interesting thing is I've always said the candles are the language of the market, but I was wrong because this is the true language of the market. The candles are kind of like, I don't know, like elementary in a sense. Not to say this is complex in the sense that it's difficult to understand because I'm just looking at the image of this. I remember once I was with Uman, this was up.
Yeah.
And I was like, what the heck is that? That's the Matrix, This is solar systems like these guys, people, Carmine, Uman, this is why you're so good because you got this Matrix hack or some sort of insider knowledge, but now you're breaking it down. It makes complete sense. And being able to translate it the way you have is phenomenal, It's phenomenal.
Right. So, I mean, even looking at this candlestick chart, you could tell something's going on here just by looking at the candles. And that kind of validates what you just said. Like, you could kind of see it on the candles, but digging deeper, it tells you really what's going on that you can't see from the candles.
Right? Have more conviction for you. Even if you're not doing like trying to size up or gamble on the trade now, but at least when you're taking it and executing it, you have more information, which only means more confidence and at least more, as you say, context.
Right. So just for this concept even further, every time we moved down, there was aggressive selling coming into the market, but the market wasn't moving down.
Yeah.
If you see the selling, the market theoretically should move down, but it wasn't. So that tells me that somebody is buying from all this selling. And this right at the key level, looking at the footprint, you can see a lot of red, volume. This is delta volume. You can see a lot of red in the bars. There's just significant selling as the market's selling off. There's no outliers here, but it's just a lot of red selling.
Gotcha.
And again, this is a bullish indication. When you add it to our level of interest, this is perfect confirmation for me. So just to reiterate this, demand zone bounced, the market moved up, there was aggressive buying. On that move up, a low volume node formed at the 63s. We pulled back into that area of low volume. We saw the passive buyer. We saw the absorption. We saw the trap sellers. If sellers are actually in the market here, and this is another very good concept, if sellers are really in the market, and this maybe isn't a seller trying to move the market down, if this seller gets in trouble and the market moves up, he's trapped. He's stuck. He's got to get out of his trade. And the only way for him to get out is to buy. And that's just going to further cause the market to move up. And that's kind of why short covering rallies form. I don't know if you ever heard that concept, short covering rally.
Heard the concept.
That's because a lot of sellers are trapped. And if the market goes against them, they have to buy. And for them to buy, it lifts the market up even higher.
Got you.
Another big thing about like how I trade is tons of effort and no reward is a reversal signal. So if you see a lot of sellers putting effort in the market to bring it down and they're not getting rewarded, they got to get out of that trade. Same thing to the upside and buyers. So that's absorption. This was my entry long when I spotted all of that passive buying, trap sellers, absorption. And what I did is because I noticed, and this is kind of where it's important to place a stop loss at an important point.
Yeah.
Let's say I did get long at this candle right here. I don't know how long this is going to take or how long it's going to develop. But prior to this, the market kept breaking the lows. So if I were to put my stop loss in this example under the previous low that formed here, it would be really easy for me to kind of get wicked out of this trade.
Yeah.
So what I did on this setup was I adjusted my stop loss 2 or 3 points under the low of the candle that I got in at, of where it formed, to give it breathing room just in case it breaks the low again. And buyers need a little lower to keep absorbing. And then I took target profits at the high a day, didn't scale out, took all out of my profits above the high. And that was a good move because it kind of pulled back directly after that. So simple moves, impulse, and that's just putting yourself in the position of large buyers and large sellers.
Phenomenal trade, that is absolutely amazing.
And you really can't, you could also even argue that like a lot of traders will wait for this like low to break. That could be good confirmation just in itself off of a candlestick chart. So it's just putting yourself in the position, $21,000 profit, 5.5 to 1 risk to reward. And why I love this strategy is because the risk is just insane.
Yeah.
If I waited for a 5-minute candle to close, by the time I would have got long, might have been up here.
Shifted the whole thing.
I'm long down here. This enables me to have more meat on the bone.
Yeah.
If I have more meat on the bone, I'm going to get more profits out of the market.
Yeah. And it matters so much as well, in particular, because obviously if you do take a loss, those trades are going to make up for, they're the ones really that are going to make up so much of the P&L at the end of the quarter year.
Exactly. Out of the traders that I know, the guys on Wall Street that are not even on social media, they have maybe 5-10 trades out of the year that make up their year.
Exactly. Yeah.
And it's so important to have large wins and smaller losses. That's the key of longevity. So this was a loss. $4,300 loss, lost my 1R, my planned risk. And similar to what I explained earlier, I basically longed when the market was at the high and not long in it at my level of interest. So this is going to show you a setup that could have worked, shoulda, coulda, would have again, and a setup that because I missed it, I kind of forced another setup up here at the high. And this was a $4,300 loss. If anybody follows me, anybody's new to following me, if you look at any of my losses, they're all in the same dollar amount. You're not going to have an outlier of a $20,000 loss. They're small losses compared to the wins because I know how much I'm going to lose before I enter that setup, and I have to obey my stop loss. If I don't, that's when I'm going to lose a large amount.
Correct.
So my plan here was a rally up, a pullback into 5710, 5700. This was an area of low volume to get long if the market could pull back into this. Here in this example, again, this is the con that I explained earlier. We could see a lot of areas of low volume. One up here, one here, another really large down here. So we could theoretically say this is one up here, this is another down here. What I did is I made the 2 lower zones. Again, I want to look for initiation areas into one zone. So in this trade, I was watching 5710 to 5700. These were 2 zones. Here's 5710.
Yeah.
Here's 5700.
Okay.
So I just made it one zone. I was watching for a pullback into it. Guess what? We get 2 perfect pullbacks. 1, 2. And I didn't take the market long there. Truthfully, I don't remember the setup exactly of why I didn't take it. But in hindsight, perfect confirmation, perfect setup. It just was not something that I put risk on for. Now, instead of taking that planned low volume node, which worked out so perfectly, I took a much lower quality of a setup, resulting in a loss, longing the market up here at the highs and stopping out when the market broke this low right there. Reason for this was, again, low volume node at the high. I was just simply longing this pullback right here. And it was at the high of the day, not after an initiation type of level or not after a level of demand bouncing. It was just an extended rally. And I was essentially longing the market at the high of the day, which I don't like doing. I don't like buying breakouts. I don't like buying higher days, lower days. It just wasn't the best even in terms of position in the market, buying it up here. I'd rather buy here. I'd rather buy here on a pullback. This pullback was even shallower and it wasn't so deep. And I stopped out under this low again, structure broke, and resulted in a loss. And it was a $4,300 loss. But the concept of this was the losses just have to be small.
Exactly.
And now here's kind of like a bonus trade. This is a really good concept. It's kind of introducing the same strategy I'm talking about, kind of with a new concept. This was a $17,000 profit.
You're lining up for a part 2.
We might need a part 2. We might need, out of the 5-6 playbooks that I have, we might need one for every playbook.
Hey, don't get as excited.
So this was a 3.5 to 1 risk to reward. Still good. You know, I shoot for 2 to 1 or better, but a lot of my setups are, again, 4, 5, 6 to 1.
Incredible.
$17,000 profit. And what this was a level of demand right here. The market the next day pulls back into this level of demand. And in this picture, you can see a little bit of a lower wick. The setup for this was I was watching if 5602 demand trades. I want to play a long targeting 5621. It's about a 20-point buffer or a 20-point rally to the upside. The market's going to pull back to an area of low volume. I get long at the 5611s, going for about a 13 to 11-point target with the 5-point stop loss under the 5606s. Now, what's interesting here is we're going to see a low volume node above price, and I use that as a target.
Interesting.
While taking the market long at a low volume node under us. So we were kind of in between a low volume node of resistance above us and below us where I got long. So here's this bounce off this level of demand. There's the rally up. And right here, we're going to put in the area of low volume. Again, the fair value gap traders will probably say this is kind of like a fair value gap.
Yep.
Not 100% sure. Again, this is a new concept, a new term that I learned about fair value gaps from comments on my videos.
You don't want to know.
So the market's going to pull back into this. Here we can see the low volume, significant right here. And you technically there's an area of low volume up here, but it's not as significant as this, I guess you could say, valley of low volume right here. And also it's not significant if it's a volume tail, you say at the low a day. So usually at lows or highs, you're going to see a volume tail. This is an example of a volume tail because that's normally at every single low or high. You're always going to see low volume at a higher low because what puts that low or high in is nobody gave a crap about that move. So when nobody cares about it, the volume is obviously going to be lower, and that's what actually forms that low.
Which would you say is outside of the auction area?
Outside of the auction area, yeah. And this is at the level of the support down here.
Gotcha.
So the significant is this 5615, 5610 area that I've highlighted here because this is just the difference in the data, in the volume distribution. Now, we have this level of low volume at the 5615s, 5610s. And I have a video I prepared here for the long at the 5602 demand, confirmations, bounce off 5602, strong bids at the level of demand, and there's aggressive buyers after. We pull back into an area of low volume, and then the large buyer or seller fills and defends prices. So I have a replay here. And this video is going to be in 4x speed. So it's going to be 4 times the normal speed of the market hitting the market.
Because I was actually going to ask you, was it like when it's in real time?
Yes.
Of how does this...
So this is going to be in real time, just a little sped up.
Yeah.
What we're going to see here is we see the area of low volume at the 5615s, 5610s. Here we see the volume tail at the low. And keep in mind, the level of demand was at 5602. So here's where the market bounced off that level of demand. Here at the bounce of demand, you could see a lot of red bubbles or a lot of selling activity. And here you could even see a large passive buyer there. Again, if there's a lot of selling, who are they selling to? They're selling to these passive buyers sitting there at the level of demand. The market bounces, forms this level of low volume, and watch what happens here when we pull back. When we pull back here, 5610, 5611 is inside this level of low volume, but I want everybody to keep an eye on 5610, 5611. I'm going to zoom in a little bit more. You're going to see a lot of aggressive selling here hitting this passive buyer. So zooming in, you could see these 2 orange lines right here, 5610.
Yeah.
Those are passive buyers in the market. Market's pulling back. Again, the concept of the strategy is putting ourselves in the position of large buyers. We can validate this by looking at this passive buyer sitting here We know he gets filled. A lot of people say, oh, I don't look at the level 2 or I don't look at limit orders in the market because they could be spoofed. That's true, but they can't be spoofed when they actually get filled like this. In this example, we know he got filled because there's a large aggressive selling print, selling volume highlighted by this red bubble, filling the passive buyer. If he didn't get filled, we wouldn't see the volume hitting him.
Yeah.
But there's somebody selling, hitting that buyer. And this, for me, right here is good enough confirmation to get long, place my stop loss under those lows, capitalizing on this passive buyer right here, getting filled. You see the selling volume on the pullback. You see the passive buyer there filling. You see the market bouncing off that level of demand with that aggressive selling volume at 56.02. And this is just the area of low volume. Now, what's interesting is why I placed my target at the 22s was because this is an area of low volume right here at the 22 to 25s. So I used it as a target. Now, what's interesting here is because now we're longing the market into this target of low volume, it would be very safe to say if the market reclaimed this area of low volume, this would be where we get very large continuation.
Okay.
And this is where you can look to capitalize on larger moves or maybe look to scale out or like kind of get creative with your trade management.
Gotcha.
That if the market holds above these 56.25s, this kind of would give validation that the buyers are strong, we're taking over the sellers, and we may have a solid trend continuation to the upside.
So is that where you could look to hold
partials? And again, this is where context comes in. And what's interesting here is the market's going to fill this level of low volume. Again, when the market spends time there, it builds volume, it fills these levels. That's how the volume gets built.
Yeah.
See how it's kind of filling and filling, and then the market just aggressively moves up. And then we're above that now. This remains now important support. We have to remain supported above that for the remainder of the day.
Wow.
And here's just a visual, not in the video example, of the pullback into that large passive buyer there. The seller got filled. You can see it by the large red bubble. Filling into a buyer. A seller has to hit a buyer to get filled. We get the completed transaction. Market lifts and rallies from there. And this is what it looks like on the candlestick chart. This is why I like sharp, aggressive pullbacks. Because traders act on impulse.
Yes.
If you're in a long position and you see the market just aggressively sell off, you're going to freak out. You're going to stop out. And that's a perfect opportunity for someone else to buy from your mistake or for you stopping out of that trade.
And more people are going to try and sell.
And more people are going to try to sell because they see these red candles coming to the downside.
Yeah.
And in the moment, you see a lower wick at these arrowed 1 minute candle here. But in the moment, it actually looked like another red candle at the downside because it was much lower.
Exactly. Yep.
So in that moment was actually that buyer getting filled. And in that moment, when we took the market long, it looked very bearish. It didn't look like this.
And that's one of, I guess, the cons in a sense is like having to have conviction in your trade
Exactly.
against the market, well, against what the market may seem like it's showing you.
Exactly.
And that's where the benefit of going beyond just the candlestick comes in, because if you're just looking at the candlestick, as you say, that would be a bearish candle. You would probably think sellers. You could be very emotional. You could get panic. Versus when you understand the deeper level that you've given us today, you have a better understanding. You can have more calmness. You can actually understand and try and dissect what's going on.
I know the worst case scenario is my stop loss is going to hit. Guess what? I accepted that risk before I entered it. I'm going to be, okay, I'll be a little upset that my stop loss hit, that I just lost money, but it's out of my control. My stop loss hit. I did everything I could. I had a plan, followed it, exited, and my risk was defined before I entered that setup. And I think that's so important, like you just said too, is that when I entered this trade long, this was a bearish candle. It did not look bullish. And it's kind of getting in. I have a saying in the market is spotting non-obvious things before they become obvious. So when you spot something that is very obvious and everybody's doing it, it's probably not a good time to be active and trade in the market versus getting in when it's not really that obvious and no one's really kind of watching it, because it wasn't obvious to take the market long there. And that just made this trade even better for me.
Exactly.
Because I know when I go deep into the order flow, someone's buying this. And worst comes to worst, my stop loss hits. Oh, well, it was a part of my setup. And I would be more frustrated if I did not take this setup than actually, let's just say, lose on it and it didn't work out on me.
Exactly.
I rather deal with the feeling of losing on a setup than having a plan and not taking that trade.
And seeing it play out.
And again, that low volume node at the 56.25s, it was a previous level of support, and then resistance. And that's kind of why I look to scale out there. Yeah. And so it was candlestick level, low volume node level, and it needed to be reclaimed for continuation. And then I got all out on the strong push up.
Incredible.
I held 50% on the move, and just putting myself in the shoes and footsteps of other large buyers and large sellers.
Carmine, I'll say two things. One, the 2-year wait was worth it, but I'm also sad that I didn't call you sooner so I could learn this sooner as well. Absolutely insane value, so much depth. Everyone at home, drop a comment with your biggest takeaway from this episode. Drop any questions. Me and Carmine will take a look at those as well. But most of all, as Carmine said, if you want an even deeper look at this, the links for Carmine's channels will be below. So go check that out for sure. Other episodes are on screen. Hit like, hit subscribe. And this has been Chart Fanatics. Until next time, take care.